Hey, what's up everyone? Welcome back to the channel. Sorry by the way for not posting these past few days. I actually had a ton of issues going on with my house and it took up all of my extra time, all of my free time. So I apologize for that, but I am back here today with a new episode of my Stock Market Weekly Update series, which by the way, I post every Saturday. So make sure you keep tuning in for those fresh new episodes. Now, as you may already know, September is typically the worst performing month of the year, and so it only seems fitting that this last week of September trading happened to also be a significant drop in the market. It's actually the third week in a row that we saw some pretty heavy declines for the stock market. And this past week, inflation came in hotter than expected. The Fed is really showing no signs of slowing down with their interest rate hikes despite the risk of recession. And we even had some earnings reports come out that shed some extra light on the state of the economy as well. So, with that said, let's go ahead and talk about everything that happened this past week. We'll cover any stock market news. I'll give my opinion on all of it. And we'll even take a look at the biggest gainers and losers this past week. And I'll let you know if I see anything there that seems interesting to me in terms of investment. So it's going to be a fun one. Hope you guys enjoy it. Let's dive straight into this. Okay, so taking a quick look at the markets, we can see that the heavy damage continued for the third straight week in a row of losses as the Dow Jones fell another almost 3% this week, bringing their total losses to over 22% from its highs, which is of course a technical bear market. Now the S&P 500 is also well into a bear market as well, as it fell another nearly 3% this week, leaving it down over a quarter of its entire value. And of course, the tech heavy NASDAQ, well, that one continues to fall as well, fell another 2.7% this week, bringing its total crash, and I do call this a crash, so you're talking about a massive drop here of 35%. I mean, that is really large for the broader market. And as a result, many great stocks have fallen even harder on an individual basis, which I've been scooping up myself. I mean, make sure you watch my recent stocks I'm buying video that I just posted before this one if you want to know in detail everything that I've been buying during this market crash. But in terms of why this is happening, or at least this in this past week, well, let's go ahead and transition now over to any market news. And this past week, we did see a few different key events that heavily influenced the market. Now, Monday and Tuesday weren't anything really too crazy, as not a lot of news was really happening, and thus the market was just kind of flat in some ways, as it was just kind of waiting for any reason to move either up or down in a more significant way. But on Wednesday, that silence really broke, and the market rallied by about 2% because the Bank of England announced that it will be purchasing 65 billion euros worth of UK government bonds. Now, why does that help the stock market? Well, it's a sign that the government is doing everything it can to ease investor concerns by pumping cash into the economy. See, when the central bank buys bonds, it's essentially the same thing as printing money, which the stock market tends to like, at least in the short term. And the reason why they're doing this is because they recently announced tax cuts to help boost their economy, but it was being funded with higher borrowing, which sent interest rates higher. But now that the central bank is buying the bonds themselves by essentially printing money at quote, whatever scale is necessary to restore orderly market conditions, well, you basically have those borrowing costs dropping back down because purchasing bonds lowers the yields and interest rates while also making stocks more attractive by comparison. Thus, the market shot up as a result, since so many other countries may choose to follow England's lead. However, on Thursday, the market decided to reverse course again and shed another 2%, which was followed by another drop of about the same amount on Friday as well. And the reason for that is because of a slew of new economic data showed that all the money printing we've been doing, well, it's still wreaking havoc across the economy. Now, to be fair, personal income and spending came in just as strong as analysts were expecting, which is a good sign, but all eyes are really still on inflation and how the Fed is reacting to it, with rising interest rates. And it just so happens that the Fed's preferred measure of inflation came in higher than expected for August, with both a year over year as well as a month over month increase, leaving us still right around a 4-decade high, which led to the federal vice chair coming out on Friday and basically telling everyone that the Fed is still committed to raising rates despite them already being at the highest level since the Great Recession, thus triggering continued fears that this too may lead to a large recession. But that's what happens when all you do is print money instead of solving the underlying economic issues that come from all of these horrible economic policies that we've been dealing with ever since the start of the pandemic. And look, I get it, the pandemic is a serious concern. A lot of people are very worried about it. But you can't just shut down the economy and create so much money out of thin air, like more than the total cost of World War II, which is crazy to think about, and expect there to not be any consequences. You just don't get away with that kind of economic policy without having to deal with the fallout from it. Having said that though, consumer spending is still looking pretty strong, and like I've been telling you guys in lots of videos, as supply chains get restored, which we have been making progress on, and with the super sharp rise in interest rates that should bring down consumer demand and spending, well, you're probably going to see a good balance there in terms of supply and demand, and inflation should take a pretty big hit as a result, at least at some point soon. In fact, this past week, we're already starting to see some of this. This past week, Nike reported earnings, and guess what? Their stock fell by over 10%. And you know why? It's because in their earnings, they announced that their margins are getting squeezed. Their profit margins are suffering because of all of the overstock that they're having to deal with, that they're now having to put on clearance. In other words, supply chains are getting restored and all of the supply is coming in, and it's more than they expected, and it's more than they thought that they'd have to deal with. And so they're having to put a lot of stuff on clearance, bringing down prices, hurting their margins. But that also has an impact on inflation too. At least it will start to over time. And we've seen similar things happen with large retailers like Target, for example, who had literally the same exact situation as Nike. And so I think when we start to see this happen on a larger scale, I think over time inflation will get more under control, and that's when the Fed will be able to stop raising interest rates and start thinking about maybe even lowering them, especially if the economy is still struggling, might even be lowering interest rates. And I think that's what the stock market is kind of waiting for, and that's what it's really wanting badly. And once it gets that, I think that's when you really get your next bull run in the market and things start to take off. The question is, do we avoid a recession? When exactly do these things happen? All these things are impossible to predict, and that's why I just remain a net buyer of stocks, because I've been seeing so many great companies just trading at really low prices, and I know that a bull market is coming at some point, so I want to be ready for it. But speaking about individual stocks, let's finish up the video now with my favorite part of every episode. That is to look at the biggest gainers and losers this past week, and I'll let you know if anything kind of catches my eye. So let's dive into that. All right, now starting with the gainers first, we always look at the more popular large cap stocks, and this week was pretty interesting. First of all, we had quite a few biotech and healthcare related companies making the top 10, with Biogen leading the entire pack, the entire list, at a whopping 35% gain. Apellis Pharmaceuticals also climbed by close to 20%, and then Ginkgo Bioworks, Shockwave Medical, and Guardant Health all climbed by around 10% each as well. The best known of these is probably Biogen, who is definitely famous for their neurological treatments, and the reason for their huge pop this week was because their new Alzheimer's drug showed a whopping 27% reduction in the spread of the disease in clinical trials, basically lowering the cognitive decline of patients. And as a result, investors are betting that the drug will become a huge seller for them over time, which drove the stock up by almost 40% on Wednesday alone. Time will tell how much the drug is able to make up though for the horrible financials, as both sales and profits have been falling for years, with revenue expected to continue declining both this year and the next. The stock is also a bit volatile, and it's still negative over the past 5 years, and they don't even pay a dividend to make up for any of that, which is actually the main reason why I invest in biotech stocks myself, because I like to get those really nice dividends that a lot of them tend to pay. But, this one doesn't pay one, so it's not really a good fit for me. And by the way, I'm pretty sure that none of these other healthcare stocks on the list pay dividends either, which is a little disappointing. Another large group of stocks, though, that we saw climb this week was a bunch of gold stocks, including Sibanye, Anglo Gold, and Gold Fields, all climbing by over 13% each. And these ones actually do pay some pretty big dividends, with Sibanye being the highest among them at a whopping nearly 9% yield, while the other two are at around 3 and 2% respectively. Now, the reason for this week's pop was likely due to all the money printing, obviously by England, since gold has often been looked at as a sort of hedge against inflation, as it can't just be created out of thin air like modern fiat currencies. But because of that, gold stocks can often be very cyclical, with Sibanye in particular down over 25% this year, but still up over 125% in the past 5 years on all of that volatility. These can sometimes be good stocks to own if you keep really good track of their mining operations, because they'll go up and down huge depending on what their mining operations are looking like. And then you also, of course, have to keep a close eye on the cyclicality and try to time that correctly. But I don't usually invest in these because it's just a little bit of a headache for me. I don't really keep up with the world of gold that much. And although I do really like their dividends, and some of these are actually starting to look pretty interesting, but I don't know. I just think for me, it's not really worth it. Another interesting stock, though, that jumped up was HashiCorp at over a 15% gain, which is an open source freemium software company that helps developers and cybersecurity companies with securely running operations on the cloud. And I think that's super interesting and a much needed service, so I definitely like that. However, this is yet another young San Francisco based tech company that barely IPO'd less than a year ago and has been in free fall ever since, as they generate even more losses on the bottom line than they even do in sales. So I just can't really get involved. I mean, I've already told you guys in lots of my recent videos that I own way too many spec stocks. I've bought too many of them this past year, so I can't be picking up another right now. Speaking of spec stocks, though, the last one on the list here is actually Palantir, which I happen to own myself, and they jumped up about 10% this week. Now, you guys have heard me talk about Palantir many times in the past, so I won't say much here, but as you know, this is a high growth data analytics, data management company that helps both the government as well as many corporations to run more effectively and efficiently. And this past week, they were awarded yet another multi-million-dollar contract by the US military for artificial intelligence and machine learning research. So the stock went up as a result. But year to date, Palantir is still down over 55% and even more from their highs. So as long as they trade this low, I'll continue to be a net buyer of the stock in small amounts over time. That does it for the gainers, though. What about the biggest losers? Well, to be honest, there's not anything super exciting this week. I mean, we do have AMTD Digital yet again making the top 10 for like the fourth week in a row. Sometimes it's a gainer, but most of the time it's a loser, having lost already another 26% this past week alone. And as I've told you guys in each episode already, this is a super shady Chinese digital solution stock that gets investigated by regulators fairly often and has fallen from a gigantic high of over $2,500 a share to just $46 today. Needless to say, I will continue to stay away from this one myself. Speaking of past guests, though, on the list, we also saw some cruise lines make another appearance here, taking another hit this week, these were actually a top loser last week too, but they were a top gainer the week prior because of falling fuel prices. But ultimately, inflation, interest rates, and a deteriorating economy, those things are just adding up. They're scaring investors into selling out of these leisure type of stocks because they worry that during a recession, people will take less vacation trips on cruises, and thus Carnival, Norwegian Cruise, and Royal Caribbean all fell by around 15 to 20% each. I actually used to own Carnival myself, but after they cut their dividend and I saw just how easily their business can be destroyed by government regulations during a pandemic, I just decided to sell, and I no longer feel like these type of stocks are like safe investments. They can be a little speculative in my opinion. Another stock, though, that was actually a top loser last week, too, was CarMax, and they made another appearance here. Now, this is a very interesting play on automotive sales, as they're the largest used car seller in America that operates through their online platform as well as some physical store locations too. But after seeing large growth last year that was boosted by the used car sales boom, revenues are now falling flat these next couple years because of rising interest rates that are making it more expensive to finance a vehicle purchase. In fact, vehicle financing is one of the largest parts of their business, but they just reported earnings this Thursday and missed on both the top and bottom line. As a result, the stock has been crashing hard and has already lost about half its value just this year alone. I gotta admit, the valuation is getting pretty attractive. I mean, at these levels, talking about a forward P ratio of only 11 and a PEG below 1. But that valuation might actually be a little more expensive than you think, since their earnings are getting worse over time and analysts may start revising estimates to the downside. Plus, the risk of a recession makes this stock just a little too risky for me personally, as I feel that there are much safer stocks in the market taking just as big of a hit right now. Speaking of earnings, though, I mentioned before that Nike had some struggling earnings, and they were dealing with overstock issues and squeezed margins, and thus the stock was falling. Well, this week it fell by another 14% and it made our list here. But some people might actually see this as a buying opportunity for Nike, since it's a pretty strong global brand. Most people know about Nike. A lot of people have owned Nike shoes and other merchandise. And this is a company that, because of that, they generate solid profits and they're still growing their EPS by double-digit percentages on average. Plus, they pay a nice little dividend of 1.5% with some good growth metrics on it, like a low payout ratio, a double-digit growth rate, and almost a decade of consecutive growth. I personally think it's a little boring of a company though, and even after losing more than half its value this year, it's still trading at a P ratio of around 24, which is just too expensive for me. I mean, I see much better stocks that trade for around that valuation, and even the dividend, as much as I like it for the growth, the yield is kind of small. So I don't know. I just feel like it's not really the stock for me. And finally, I just want to mention that Coty, COTY, also fell by another 14% this week, which is a famous makeup company that owns more than a quarter of the entire North American cosmetics market share. But I honestly know nothing about that market, so I've never purchased any makeup stocks myself. Looks like they've been making some great progress though on profits, with last year being their first year of profitability. So if the trend continues, they may have a bright future, but as of now, the stock has been crashing for years, and it's just not something that I've ever thought about getting involved with. Anyway, that's going to do it for today's video, this week's market update and recap. Hope you guys enjoyed it. Let me know what you think down below. Any stocks that are catching your eyes? What stocks are you guys buying out there? Or are you just kind of staying away? How do you feel about all the market news? I'd love to hear your thoughts. I'll respond to your comments as well, and we can have a nice little chat together. But thank you again for stopping by, for all the support. It means the world to me. And I will catch you in the next one. Hope you're all doing well. Take care. Bye-bye.